Can you all see my screen with him? Pray that the network does not interrupt us today because can you guys hear me? Can you guys see the screen? All right. I had to switch my network. So like I was saying, can you guys hear me and can you guys see my screen? Can you guys see my screen? Okay. So today's class is one of the most, I think, if not, well, I wouldn't really say it's the most important, but it's one of the most important topics you need to pay attention to when it comes to trading anything in general. Because aside from this particular strategy, every other strategy that you trade still revolves around you knowing what the market is saying on the higher time frame, then trading in that direction on the lower time frame. Now, most of the time, there are some pairs that we already know to be bullish most of the time. But aside from the fundamentals that some pairs are always bullish, like we already know that majority of the time gold is mostly bullish. But there are some times that they are declining, like those pairs declining in price. So we can't really just trade one direction of the market in with hope. So that is why directional bias is very important when it comes to trading the structure. Sorry, when it comes to trading this particular strategy. Now, there is really nothing complicated when it comes to directional bias. The thing that affects most traders is they always think about trading from a technical standpoint. They always think of trading from like, oh, technicals, the lines on the chart, but they forget that this trading is done by humans. Like the trading on the charts, the way market moves is basically supply and demand. Like you pump money into the market will move, you remove money from the market will sell. That is basically what the market, like the whole thing. So they forget that psychological aspect of trading, like the human psychological part of trading, and they focus mostly off of what they see, the lines on the chart and so on and so forth. So that is why most people do not actually apply logic when it comes to trading TA and when it comes to like trading in general. So that is why most people make mistakes when it comes to trading. And I am going to teach you guys how I apply directional bias to my own strategy that I trade. So, first of all, we already know that there are three basic ways that market makes its movements. So, it's either price is trending to the upside, or price is trending to the downside, or market is ranging. These are the three ways that price makes its movement. Now, these three ways that price makes its movement can also be applied in us getting our directional bias from the markets. Now, directional bias doesn't really necessarily have to be what you are trading, going to trade for like a whole month or 2 months. It can be something that you're looking out for to trade for like a week or 2 weeks, sometimes 3 days. As long as it's something that's influencing the market on the higher time frame, that is basically directional bias. So for me, I trade my directional bias from the either the daily time frame or the 4 hours time frame, just these two time frames. And the thing is that once I get my directional bias, for my pair that I'm trading, I tend to trade that for an extensive period of time. Like I can be selling gold for like 2 weeks, 3 weeks now. In fact, the whole gold sale started happening since 16th October, and market, this is literally 30th October, more than 15 days, and gold has been bearish. And then the whole buy that was happening since has been happening since, like I would say, 18 September all the way to October. So for more than a month, gold has been bullish, directionally bias speaking. So that is the mistake that most people make, is that they analyze every structure they see, every market structure they see. They are looking for inducement, they are looking for POIs, and they are taking buys. Every double break or structure they see, they are taking, but they are ignoring the most important thing. Am I trading in line with the general direction of the market? Which is what you guys should focus on first. And mind you, once you get the general direction of the market on the higher time frames, you don't need to keep looking for them for the new direction every single day. You can literally trade one direction of the market for an extensive period of time. Like you can have a directional bias that is bullish, and you're focused on looking for buys for like a whole month. You're trading just one thing. Or market can be bearish, and you're trading that bearish move for a whole month also. That is the importance of bias. And it also helps you know, it makes it easier for you if you know what you're looking for, it's easier to find it compared to when you don't know whether you're looking for sales or whether you're looking for buys. So you're basically looking at every other block you see in the market. You're looking at every breaker block you see in the market. Don't not minding whether it's bullish or bearish, but you're still paying attention to every PUI that you see in the market. So it's very important that you understand the direction of the market before you start looking for trades that now confluences that direction of the market. Hope you guys are following me up, please. So there are two ways that we can apply directional bias, two major categories. The first one is by applying the normal way that price makes its movement, that is by using the trending markets and the ranging markets. Then the second way is basically applying the same analysis that you do on your lower time frames on your higher time frames too. So what do I mean by that? I mean the same way you see like you see sorry, the same way you would see market giving you like a structure shift, inducement, then this is your point of interest, and you trade it and target this higher, so take profits. The same way you will trade this on the lower time frame, you can also trade this on the higher time frame. That's what I mean. That is one of the ways you can apply directional bias. But remember, when you're dealing with directional bias, you are trading on the 4 hours time frame or on the daily time frame. That is it. So that directional bias confirmation or whatever is should be done on the 4 hours time frame or on the daily time frame. That is what I use to trade my directional bias. So that is one of the ways you can apply directional bias, by applying the same analysis that you would normally apply on the lower time frames to the higher time frames. Because once again, structure is structure. So your structure shift or double break of structure that you would normally trade on the lower time frames can also work on the higher time frames. The only difference with the higher time frame is that if it would take you 10 minutes or 1 hour for the POI to trigger on the lower time frames, it can take you days for it to trigger on the daily time frame or the 4 hours time frame. And if it would take you 15 minutes to 1 hour for your take profit level to hit on the lower time frame, it can take you weeks or months for your target to finally hit on the daily time frame or the 4 hours time frame. Now the thing is that we are not necessarily trading the 4 hours time frame or the daily time frame. No, the daily time frame is just to have that analysis. When price triggers that POI, you now start trading in line with direction of whether your trade on the higher time frame is going to. Because now 4 hours time frame, there are about, I would say, 6 4 hours candle in a day. Yeah, I'm correct, right? 6 4 hours candle, 4, 8, 12, 18. Yeah, 6 4 hours candle in a day, that's 24 hours. It means that just on the 4 hours time frame, once price moves this candle here, this candle here, this candle here, and this candle here, and this candle here, a full day has closed. Do you understand? So if you had a target of here, before price would actually get to this target, it will take you about 2 days for this target to get hit. So if this is an analysis that you have on a daily time frame, before you can finally get to this target, it will take you about 10 days, sometimes 5 days, sometimes 2 weeks, depending on the volatility of the market at that given moment. So it means that whichever direction that you've analyzed the market to go to on the higher time frame, still using, like, you have to use the same structure inducement PUI method that you normally use on the lower time frames. But once that PUI has been triggered, before price will get to the final target you have, the directional bias for the markets will be to trade alongside that direction of the market for the analysis that you already made. So if this is the structure inducement and your PUI getting tapped, and your point and your target for the market is here on the daily time frame or the 4 hours time frame, depending the on the time frame you got the analysis. Before this level has been met, it can take weeks. What it means is that before price gets to this zone, you're expecting to take your profit, your bias of the market is going to be bullish. So that is what I mean by applying the same concepts that you would normally do on the lower time frames on the higher time frames also. That is one way you can trade um directional bias. The other way you can trade directional bias is by just using the normal basic movements of the market. That is the three ways that price makes its movements: the uptrend, downtrend, and the ranging market. So already we understand that there are patterns that price makes its movements. If market is bullish, it's going to maintain an uptrend like this, and if it's bearish, it's going to maintain a downtrend like this. So these are the ways that price makes its movement. Once market is bullish, it will maintain an uptrend. If it's bearish, it will maintain a downtrend. Now, or when it's not moving, it's going to just keep ranging, but there are just very few pairs that range. So what this means is that on the 4 hours time frame or on the daily time frame, you find the way that market is currently moving at, whether it's trending to the upside or it's trending to the downside or is ranging. Like I said, three ways that price makes its movements. You have the bullish markets, we have the bearish markets, we have the ranging markets. These are the three ways that price makes its movement. So these three ways that price makes its movement, you can apply to your directional bias, because you already know that we look for our directional bias on the higher time frame. So what it means is that once you open up your chart, remember, when you're looking for directional bias, you're looking for it just once. Just once. So once you have it marked out, we also have the target marked out. So you're basically going to be trading in that direction of the market that you already had gotten before until price gets to the final target. That is how you trade directional bias. So using the ways that price makes its movement, that's what we're going to talk about first. So let's go to the uptrend part of it first. So now, if you open up a chart and you just go to your daily time frame or your 4 hours time frame, it's so easy to discover the current pattern of the market. Like, it's not hard. If you shrink up your chart, you can tell whether market is moving up or is turning down. If you open up your chart, you can tell whether market is bullish or bearish. If you open up your chart, it's so easy to tell whether market is what, bullish or bearish, just by looking at the chart. From here, you can tell that market is bullish. From here, you can tell that market is also bullish. From here, you can also tell that market is bullish. So what you need to do is just that whenever you open up your chart, you shrink up your chart on the 4 hours time frame or on the daily time frame to discover the direction of the market, whether it's bearish or whether it's bullish. That would help you to know the direction of you're expecting to trade in. Same here. If you open up your chart, you can clearly see this is a bullish move. This is also a bullish move. So just open up your chart on the daily time frame or on the 4 hours time frame. Mostly, I focus mostly on the daily time frame. It's easier for me like that. So if you open up your chart on the daily time frame or the 4 hours time frame, you can be able to just shrink up your chart and observe the market well to know the direction that market is currently moving at. So if market is bullish, you already know that you're expecting to join into the bullish move. Now, when it comes to directional bias, we majorly focus on trading in line with the current direction of the market. If market is bullish and giving us higher highs and higher lows, we should be expecting to still focus on taking buys. And the market is bearish on the daily time frame, we should also expect to keep taking sells, because unlike the lower time frames, takes a long period of time for market to exhaust a trend. If market is bullish, it can buy for like 3 months. So except you're a swing trader that can wait for 5 months for shit or structure for market structure to happen, inducement and the POI to get tapped, it's going to be easier for you to trade in line with the direction of the market when you're dealing with the higher time frame than for you to be waiting for a structure shift, inducement, and POI to reverse that trend of the market, because it can take you a whole 5 months for that to happen, or 3 months or 2 months, depending on the volatility of the market at that given moment. So it's better you trade in line with the trend of the market on the higher time frame than looking to oppose it. You can only start doing those reversal things on the lower time frame because the market can move so fast on the lower time frame compared to the higher time frame. So now, let's open up your chart. Observe the pattern that market is using to move at that given moment. That is one way you can get the the market direction. So once you get the market direction, whether it's a bullish move or a bearish move, all you need to do is what to draw out either your trend line for that given pattern at that moment, or this is what you do. So if it's an uptrend, you clearly see market giving you higher high, higher low, higher high, higher low, higher high, higher low. But the thing is that when market is giving you a trend, it's not just reacting off of the air. There are zones in the market where the reversals most likely to come in. For example, if you should have a trend line and you draw out your trend line, yes, the reversals will bounce at the trends, but at the same time, markets will supposedly bounce off of higher time frame POIs. Like for example, it can come to a breaker block here. Remember, the only two POIs that we make use of are breaker blocks and other blocks. So these are the same two POIs that we'll focus on when it comes to dealing with directional buyers, points of interest. So what markets will do is that they will pull into your trend line. Yes. But at the same time, like I said, there are many ways to trade directional buyers, but I'm just taking it with the trend for the first one. They will pull into your trend line, but at the same time, they will also pull to zones like higher time frame POIs where you would normally expect reversals to come in. What do I mean by this? So they will either pull into those POIs or close to those POIs. For example, let's say I draw my trend line. Now, my trend line connects here, but at the same time, this zone I'm expecting the buy to come in is close to this breaker block here. Do you understand? This zone that I'm expecting market to react to is also close to this other block level here. So the higher time frames, the zones on the higher time frame, would normally expect reversals to come in, can also match the trend line that you draw. For example, this zone is close to this other block level here. So the zones on the higher time frame that you mark can also connect with your trend lines. That is one thing. So if it's on the higher time frames, most of the time it can be breaker block connections. Even if you draw out, extend this trend here, after mitigating this one, price also mitigated a bounce from this trend line, but at the same time, it's also at this higher time frame breaker block here. So if you draw out your trend lines majority of the time will also confluence at higher time frame points of interest. And that is like more like a double confluence self. So if market is trending to the upside, there will be a particular structure in which market is using to trend. So if it's giving you higher highs and higher lows, sometimes it can most likely be bouncing from breaker to breaker. So for example, market gives you a higher high, gives you a higher low, gives you a higher high, gives you a higher low. But the higher low it gives you can be market bouncing to bounce at the trend line, but at the same time, it's bouncing off if a breaker block on the daily time frame or the 4 hours time frame. Something like this, then come out again. Once it bounces here, it's also bouncing at what? Either a 4 hours breaker block or a daily time frame breaker block or other block, depending on the POI that is there in the market where the reaction is expected to come in. So that is one thing first. The market is trending to the either the upside or to the downside. All you need to do is find out the trend, number one, and it's so easy to discover a trend. All you have to do is what go to that time frame and observe the current trend. If it's an uptrend, you will see higher highs and higher lows. If it's a downtrend, you will see lower highs and lower lows. If it's not trending and is ranging, you will see markets basically moving from support and resistance, resistance to support. support, resistance, resistance to support. You will see either one of these three for price to have a proper direction. So that is one thing first. One thing to get is the direction of the market, and it's so easy to guess. Once you shrink up your chart and look at the daily time frame, you can tell whether market is bullish or bearish. If you open up your chart on gold, you can see that gold has been bullish, 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 bullish. So it's very, very, very obvious that the market is bullish. If it's bearish, you will see because market is going to be trending to the downside. For example, when gold was bearish, it was so easy to spot that gold was bearish. If it's bearish, it's so easy to spot that it's bearish because you will see market declining and giving you lower highs and lower lows. If it's bearish, it's so obvious to spot that it's bearish. So depending on the time you are making your analysis, you either say that market is bullish or market is what? Bearish. So that is first things first. Identify the trend of the market on the higher time frame, which is so easy to do. A beginner can do that. Then once you've done that, next thing you're going to look at is how will I join in this trend of the market? Are you guys following me up, please? Okay, 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 yeah. So, like I said, first things first, you find out what the market is doing on the higher time frame, which is not difficult to do. If you read Candlestick Bible if you've read Candlestick Bible, you've taken any beginner class in technical analysis, it's so easy to identify trends. So if you go to your higher time frame, go to the daily time frame or the 4 hours time frame, shrink up your chart and look at what market is currently doing at that moment, you can clearly tell whether market is bullish or whether market is bearish. Let's say we ignore this entire thing that happened here on gold and we are focused on this. If you open up your chart at this moment, you can clearly see that gold was bullish because it was basically just trending from what? Giving us higher highs and higher lows, basically trending to the upside. So anyone that sees this move will be focused on taking buys on gold because you can clearly tell that it's an uptrend based off what market is doing, giving us higher highs, higher lows, higher highs. It's been a bullish move. So that is one thing to identify the trend of the market on the higher time frame. Then the second thing is now to find out where to join those trends and then continue, like where to join and continue the current trend of the market. That is where this thing comes in. So first of all, you identify the trend of the market. Second of all, you map out places where price is most likely to pull into. So remember, we use order blocks and breaker blocks. These are the two POIs we'll most likely also focus on the higher time frame too. So on the higher time frame, either you use your trend line to draw out the pattern of the market, and once it connects, also pick out maybe like your rectangle box and draw out the zones that market is most likely to pull into. And if they match with the trend line you drew, more perfect. So let's say, for example, you draw out a trend line here, you're expecting price to bounce there on the daily time frame, but at the same time, it also matches this breaker block level. This is a double confluence that will help, like, will be like, okay, I'm I'm actually excited to hold market at this level because not only is market at the higher time frame POI, at the same time, it also confluences my trend line. So it's perfect. Now, after that, next thing, so, so after that, so you can see this one. You can also see here, this is the trend line touch, but at the same time, is an order block on the daily time frame. So if you notice, when markets yeah. So if market is bullish, you can tell that it's bullish. Then you now go to daily time frame or the 4 hours time frame to be able to draw out zones that market can possibly pull into. So once you draw them out, you wait for price to now get there. Now remember, we're trading the higher time frames and not the lower time frames. And we're not actually placing our trades on those higher time frames. We're just using the higher time frames to get the directional bias of the market. And we're looking for that directional bias just once until like the bias completes. So now let's say that this is the market and this is what I've drawn out because market is on an uptrend. So it's basically moving, giving us higher highs and higher lows. So knowing that an uptrend is made up of a series of higher highs and higher lows, if a higher high has been made, next thing that will come is what? A higher low. And if a higher low has been made, next thing that will come is a higher high. So what you need to do first is to wait for price to pull into the zone where you're expecting the bounce to come from. That bounce will be like a reversal. So let's assume that on the 4 hours time frame or the daily time frame, we have this breaker marked out. And on the 4 hours time frame or the daily time frame, market is now at that breaker. That is one of the stages. Now, step two, what do you now do when market is at that zone you're expecting reversals to come in? That is when you now look for the reversal concept. Now, remember, a reversal concept means that whichever direction the market was moving at before, you want to oppose direction to the opposite side. So because this was like market, the market bias is bullish overall, but this temporal sell the market did to approach this level that I'm expecting the bounce to happen from is like a mini sell. Now, for market to now continue moving again from this level, I need to get the concept of reversal while market is at the same level I'm expecting a reversal to come into. Now, I already marked out the daily time frame POI or the 4 hours time frame POI here, and I'm expecting price to reverse from that particular zone. It must not necessarily be perfect on the zone, but as long as it's enclosed inside of the zone, like I've marked out the zone, and then even if price dips into it a bit, and then it does not really matter as long as I get that confirmation one market is there. Remember, the confirmation is a one-time thing. We're not steadily looking for confirmation every time. We only look out for the confirmations when price pulls into the daily time frame POIs we're expecting reversals to come into. One thing I will tell you is that whenever market touches a point of interest on the higher time frame, be it a daily time frame or a 4 hours time frame, there must always be retracements. There must always be confirmations. That is when you're looking at daily time frame zones. There's no way that price will pull into a zone in daily time frame that it will not retest. For example, let me show you guys something. Yeah, price tapped into this zone. When it went to what they do, it retested. It tapped into this zone. When it went to what they do, it retested down here again. Tapped into this zone. What they do when it came back, it retested down here again. So there's no way price will hit a daily time frame zone and not retest later on. So that retracement is basically the confirmation that we need. And that confirmation that we need is what? The concept we trade reversals with. Now, that concept we trade reversals with, what is it called? The reversal concept, what is it called? Exactly. So our reversal concept is called a market structure shift. So what it means is that the zones, now remember, it does not necessarily have to be a trend line. Even if it's a daily time frame order block or a daily time frame breaker block, that does not really, because it's not really every pair that like moves well with trends. There are pairs that move, but they are not moving clearly in a trend-like manner. That is still okay. So it does not really necessarily have to be market touching trend line. Then this, even if it touches a higher time frame POI, good and fine. That's why I said there are two ways: the trend pattern, that is, I'm using normal structure, and then using the normal analysis that you can normally apply on the lower time frame to the higher time frame. That I will teach that one also. But for now, we're focused on when market is giving you trend-like patterns. So when market is at the zone you would expect the reversal to happen from on the daily time frame or on the 4 hours time frame. Now, this is one thing. We don't get confirmations on the daily time frame, and we don't also get confirmations on the 4 hours time frame. We look for confirmations on lower time frames. So what it means is that the moment that price is at the level you're expecting reversals to come in, you have to now scale down to lower time frames and get the concept of reversal, while market is still at that level you're expecting the reversal to come in. So let's say this is the 4 hours breaker block or the daily time frame breaker block, and at the same time it matches your trend, because you already know that this is a bullish market. Once you looked at the daily time frame, you can tell the market is bullish. So what you do next is what? A bullish market will always have pullbacks. It's not going to just be bullish forever. Anything that makes a higher high will make a higher low. And anything that makes a higher low will also make a higher high. So what you need to do is that if market is already at a higher high, you already know that a higher low must be made. So what you need to do is that to wait for market to come into the zones where the higher low is going to be made. So you can mark out those zones, which is going to be either your higher time frame block breaker blocks or your higher time frame order blocks, or just the zones that matches your trend line, depending on the pattern that market is moving at that given moment. Remember, the market is dynamic, so it cannot really be on the same pattern forever. Sometimes they can give you this pattern, or the main thing is just to adapt to what the market is saying. So once you have the zone marked out on daily time frame and price already at that level, you're expecting that reversal to come from. Now let me draw out two time frames. Let's say this is the daily time frame. This is the daily time frame here. And then I would say here is the 15 minutes time frame. Oh no, let me use 1 hour time frame. Now, the daily time frame is to mark out the zones where price can pull to. Now, on the 1 hour time frame is to get the concept of reversal while markets at that zone we're expecting the bounce to happen from. So now on the daily time frame, it will take a lot of candles to get at this level. But let's say the market's already at that level. And at the same time, price will also be at that level on the 1 hour time frame. But the difference in the movements of the daily time frame and the 1 hour time frame is going to be very, very, very much. Because on the daily time frame, you cannot really have a clear market candle movement. Because this is market coming to the daily time frame zone to trigger. This is it here. Can you see that there are few candles here and there's not really much of any movements here in the market? So it's not really that clear. It's just market coming like with huge candles to approach this POI. So it's not really that clear. But on the 1 hour time frame, it's going to be clearer. So let's see on the daily time frame, this is market coming to trigger the point of interest. But on the 1 hour time frame, let's say this is the zone you're expecting that bounce to come. On the 1 hour time frame, this will be the market movement. So let's say this is the zone we're expecting the bounce to happen from. So this is the same price movement. This is the same zone, and it's also the same zone here. But the only difference is that this is the daily time frame, and this is the 1 hour time frame. Now, what do you now expect here? You're now expecting market to give you the concept of reversal while it's at this same level. You're expecting the bounce to happen from. Now, you're not looking for that reversal concept on the daily time frame. You're now looking for it on the 1 hour time frame. I'm losing my voice a bit. So, on daily time frame, price is already at the level you're expecting the bounce to happen from. On the 1 hour time frame, price is also going to be at that same level. But the difference is that you don't look for the confirmations on the daily time frame. Whenever you get your POI on the daily time frame, you look for your confirmations mostly on the 1 hour time frame, 30 minutes time frame, 45 minutes time frame. Than so you don't look for your confirmations on the same time frame you saw the POI. That is for directional bias confirmation. I don't use normal confirmations if market is already moving. I don't use confirmations. But the first time I'm getting the directional bias of the market, I have to use confirmations. And then if you get the POI on daily time frame, you get the confirmation on the either the 2 hours time frame, 1 hour time frame, 30 minutes time frame. It works. So what you do is that once market is at the level you're expecting the reversal to come in at the daily time frame, it's going to be at the same zone on the 1 hour time frame. What you start looking for is now market to give you the concept of reversal while at the same level. So if market should come here, this will be the pattern that is using to approach the 1 hour time frame, and this will also be the pattern it will use to approach daily time frame. It's going to be more impulsive on the daily time frame, but it's going to have more candle movements on the 1 hour time frame. So you're expecting market to give you something like this, a structure shift to take out this high. Now, once this happens, it will just look like a candle retracement on the daily time frame like this. It will give you your inducements and then eventually come to trigger your point of interest. Now, the moment you get this pattern at the same level, you're expecting a bounce to come into the market. The moment this happens, that means that you've already confirmed the next move of the uptrend. Now, market is bullish. And the bullish market is made up of what? Higher highs and higher lows. But for each higher high that has been made, a higher low will also be made to complete the trend. So for each higher low, there are zones where markets react from. Those zones that markets react from are the zones that you have to mark out on the daily time frame or on the 4 hours time frame. And how do you mark out these zones? You either use your trend line and connect the structure of the market, or you can still combine using your trend line and also marking out higher time frame POIs where price can possibly pull and reverse from. Now, our market is at those zones. You don't just jump into the market and enter immediately. You now scale down to lower time frames to get your confirmations. And that confirmation must always be a reversal concept. That confirmation will always have to be a reversal concept. And that reversal concept has to be gotten where market is at the same level you're expecting that reversal to come in, which means your higher time frame POIs, your higher time frame order block, your higher time frame breaker block, your higher time frame trend line touch. So once those reversal concepts occurs while market is at this level you're expecting the reversal to actually come into, that is the zones that I just mentioned, that is when you can now confirm the next trend to the upside being valid. So once market gives you this concept of reversal while at the same level you're expecting a reversal to come in, then you've confirmed the next leg to the upside. So once this happens, it means that the directional bias of the market is now what? Bullish. So this whole thing that happened here can just be market giving you this on the daily time frame, then pulling back down again like this. So once this happens, you're not paying attention to daily time frame, you're paying attention to the 1 hour time frame, 2 hours time frame. In fact, if you get a daily time frame POI, you can even use 4 hours to confirm. If you get a POI on the daily time frame, you can use 4 hours time frame to confirm. I think it's more effective like that. So if you get a POI or market tapping into a reversal zone on the daily time frame, you can use 4 hours time frame to get your structure shift, inducement, and price coming to tap into your order block. I think I've done something like that before. And it's even this current trade. So I'm coming. Yes. So daily time frame and the confirmation was on the 4 hours time frame. You can see structure shifts, inducement, then order block. I'll show you guys. So the zone you're expecting the reversal to come in, if you get a daily time frame zone, it's even better to get the confirmation using a 4 hour time frame because the daily time frame POI. So that confirmation is a one-time thing. Sorry, are you guys following me up, please? Okay. Okay, good. So, like I said, the confirmations, if you get the POI on a daily time frame, try using the confirmation, try getting confirmations on the 4 hours time frame. If the POI came from the 4 hours time frame, try using 1 hour time frame to 2 hours time frame for confirmation. It works like magic like that. So like I said, if it's daily time frame that your POI triggers, like the daily time frame POI that you use for the zone that you're expecting the reversal to come in for the directional bias, 4 hours time frame will be more stable to get your direction, your concept for reversal. Remember, you don't trade the zone until you get that reversal concept, and it's just one-time confirmation that we're looking for. So our market is at this level on the daily time frame. You will see market just give you this kind of move, just like it did here. We drew out the zone that price was supposed to come to, the trend line here. And at the same time, it matches the daily time frame breaker block. While price came here, you can just see market do this, spike up, spike down again, and push up. That's on the daily time frame will look so confusing to you. You wouldn't really understand what is going on at that level. But on the 4 hours time frame, you will see market clearly give you a structure shift, an inducement, and then come to tap your POI. Once that happens, you have confirmed the next leg to the upside. Once you've confirmed the next leg to the upside, you can now say successfully that the directional bias of the market is now what? Bullish. Because in this scenario, I'm using a bullish scenario. And then if it's bullish, where do you not expect your target to be? So logically speaking, let's come to logic now because some people don't apply logic to trade and it pisses me off. Logically speaking, what is an uptrend made up of? Please, I want to ask you guys this question. What is an uptrend made up of? Exactly. So everyone here knows that an uptrend is made up of higher highs and higher lows. Good. So tell me, why people will see a clear uptrend, see markets at a higher low, it is now buying up to go and make a higher high. Market has not yet made a higher high, they are now selling the market. Please tell me why. Just explain that logic to me. No, most times people are somehow, and it pisses me off sometimes. Market is bullish, good and fine. Use daily time frame, like I'm explaining to you guys. You get the zones you're expecting the reversal to come in, good and fine. You get the confirmations. If it's daily time frame, you use 4 hours and you got your confirmation. Very, very good and fine. After doing that, you now open up your chart, and then market has not yet completed the cycle of the new trend. You are reversing it. Why? So now, logically speaking, if market makes a higher low here and gives us the confirmation that we're looking for by giving us a reversal concept. Remember, the confirmation has to be a reversal concept. The confirmation has to be a reversal concept. I'm saying it now. If it's daily time frame, I will suggest going to daily 4 hours time frame, 2 hours time frame to look for your confirmations, depending on how volatile the market is. Once you've gotten that reversal concept confirmation, you're now sure that the next leg of the trend has begun. So now market is now bullish again, and then is on an uptrend, and an uptrend is made up of higher highs and higher lows. So I would say it's safe for me to say, I'm not a genius, but let me just say, technically speaking, if you're on an uptrend that is made up of higher highs and higher lows, and you've confirmed the higher low, the next logical thing for market to do is what? A higher high. So poor FX. Tell me why market has not made a higher high and you're selling the market from an order block you saw here. Please explain to everybody why. John the Alchemist. Explain why the logical way of market making its movement is higher highs and higher lows. You've confirmed the higher low. Market is on its way to make a higher high, and you are reversing the market direction. Melin, you get magic. So that is one thing about people that pisses me off. They don't try to apply logic to their trading, and it's actually very sad, because if you apply logic to your trading, you would actually get a better result than just drawing lines on the chart. Even if you like, draw 10, have the most beautiful structure shift in history, have the most beautiful inducement, and have the most beautiful untapped order block. If you are trading in the wrong direction of the market, it will destroy and discombobulate that your POI. So, have you seen how market is when you are wrong? You have everything in order, you've marked it out. Market taps into your order block, gives you view once profit, and then by the time you go back to screenshot your profits, it has wiped up everything. That's what market is going to do to you if you're trading in the wrong direction. So first of all, once you get that confirmation on the higher time frame, once you get that POI that aligns with your trend, a market comes to that POI and gives you your reversal concept confirmation. Remember, I'm saying it's your that reversal concept is the confirmation you should be looking for. Once you get that reversal concept confirmation, next thing to do is now to trade market in the behavioral pattern of the trend is on. So we got the reversal concept confirmation here for this market at this POI. Now, the behavioral pattern of our trend is higher highs and higher lows. And where is our higher high? Here means that this high needs to be what? Taken out. So what it means is, I'm just guessing here now. What it means is that since the market does higher highs and higher lows for an uptrend, and you've seen a higher low, we're expecting market to what? To give us a higher high. So I don't think we need God to come down and tell us now that we're expecting to buy the market until price takes out this high. Do we need people to come and tell us that? Hmm. So, so like I was saying, once you marked out, remember what I said, get the trend of the market on the daily time frame. Get the POIs you're expecting the reversals to come into on daily time frame. Wait for price to come there, then go to like the 4 hours time frame, 2 hours time frame, or 1 hour time frame to look for your reversal concept. Once you get that, then you've gotten the confirmation that the trend of the market is going to hold. Then, after you've marked it out, then comes the target of the market. So the behavioral pattern of an uptrend is higher highs and higher lows. And since the behavioral pattern of an uptrend is higher highs and higher lows, our target will be to buy this market until price takes out this high. So what does that mean? So let me use this one now. I drew out here. This is daily time frame. I've marked out my daily time frame. The trend line connects, and at the same time, it connects with this daily time frame breaker block. So price got there. So once price is there, I'll go to my 4 hours time frame. Once I go to my 4 hours time frame, I will expect price to give me what? A reversal concept, which is what? When price took this high out, gave me this week as my inducement, pushed up again to take out the high, then eventually came back to mitigate this other block as my POI. Now, once this happens, I've confirmed the next move to the upside. And then once I've confirmed the next move to the upside, then I can now start trading any time frame I want to trade. The confirmation is needed on the 4 hours time frame or the 2 hours time frame. But once I've gotten that, I can trade whichever time frame I want to trade. I want to look at the 3 hours time frame and see if there was a clearer analysis there. Actually, there wasn't it was on the 4 hours time frame that it was clear. So that's why I suggest the 4 hours time frame, actually. So, because if it's a daily time frame, it's better to get that confirmation on the 4 hours time frame. And just so you guys see that I'm talking about the same thing that I did, this was it. Just so you guys know that I'm talking about the same thing I do. So I marked out the daily time frame. You can see me marking it out with this blue rectangular candle, this blue rectangular box. And when price got there, did that enter from there? No. What did I do? I waited for that confirmation here. That confirmation now happened on the 4 hours time frame and price triggered my POI. Doesn't have to be perfect. Just have to know that price will give you a confirmation and trigger a POI on the 4 hours time frame. Then once the price gets there, what do? You now have confirmed the next move to the upside. After confirming it, the next thing you now do is to now mark out the target. Now the target is what you now still go on that daily time frame for. So if you go to the daily time frame, you check what you're trading. So what I'm trading on the daily time frame is what? An uptrend. And an uptrend is made up of higher highs and higher lows. Meaning that now that I've confirmed the higher low on the next thing for market to do is to give me a higher high. So what was last high? Here. So since this is the last high, it means I'm bullish until market takes out this high. So from then onwards, what it means is that the directional bias for this particular pair that I'm on is bullish until this new high here, this last high has been taken out. So what does this now mean? It means that till market takes this high out, I'm only going to be looking for bullish scenarios. Are you guys following me up? Good, 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 good. I like that you guys are following me up. That's someone is asking me how is that a valid? That's a valid OB. Just that it looks different, but it's an OB. I don't know if you've never traded an OB like that before, but just go search up how OBs look most times. So so now you will now be the one to choose whether you are going to take a trade off of that 4 hours time frame that you got the confirmation from, or you can choose to go to lower time frames and get more confirmations and trade or what not. But me, I took the first ever trade from the 4 hours time frame. Now, it does not mean I will hold that particular trade to final TP because, like I said, it will take an extensive period of time for the TP to hit. In fact, it depends on the volatility of the market. But if you are to check, this thing triggered on the 15th of May. I got the confirmation on the 16th of May, and then the final target hit on the 3rd of September. So May, June, July, August, September, trading one bias for like 3 months. So that literally supplied me with 3 months of one bias from one confirmation. So now, once you get that confirmation on the 4 hours time frame, you've already gotten the direction that market is going to move at. What? So if and also remember, market may not even give you a perfect structure shift, inducement and POI at that first time reversal zone. It may just be market on the 4 hours time frame doing something like this, hitting that zone on the 4 hours time frame. Let's say this is the daily time frame. It hits the zone like this, then does something like this, then comes down to like do this. This is can still be the confirmation because it's the 4 hours time frame you're looking at. So this is still a valid reversal concept at that 4 hours time frame because the candles are going to be thicker. But because it's daily time frame, the confirmation will be much easier to get on the 4 hours time frame. So even if you see something like this, valid reversal concept. But most times it can just give you a perfect structure shift, inducement, and a perfect order block. Very valid. So once price taps into that zone, we're expecting a reversal from on the daily time frame. That's the one step. Second step, go down to the lower time frame, that 4 hours or 2 hours or 3 hours. Get that confirmation by getting the reversal concept. That is the second step. Third step, on that daily time frame, check the behavioral pattern of the trend they are trading. If it's an uptrend, it's made up of higher highs and higher lows, meaning that now that the higher low has been confirmed, the next place for price to go to is the higher high. So it now means that the directional bias of the market is bullish until a new higher high. So what you now do is what? You now start trading. Every day that you wake up to trade, your focus should be to look for buys until your price gets to that high. Even if every day you wake up to trade, your what you have in mind is I'm bullish until price takes out this high. So the first trade we took came from this 4 hour zone. After that, you can literally go to any time frame again and be trading. Does not really matter. But after that, the second trade. So after that, I will now start trading my normal time frame, which is like the 1 hour time frame. The first time confirmation is the 4 hours time frame, good and fine. But after that, you can now start trading your normal time frames that you trade. But now you have a direction in mind. So this is the first zone I took the trade off of. After that, I'll focus on looking for more trades. So I think can this be a double break of structure when this high got taken out and then this high also got taken out? The closure of the high of the double break of structure is this. After that, price gave us an inducement and push up to take out that high again. So this is a valid inducement. So with the rules of picking a proper point of interest, price came down and mitigated the breaker block. This is the second trade here. So now you can now be targeting the nearest draw on liquidity to take your trades in the market, like your TP. So for example, you can now start applying your normal take profit levels. But overall, we already know that market is going to take out this high. So you can now, based on how contented you are in the market, as long as your TP does not exceed the overall direction of the market, you can now target the nearest draw on liquidity for your take profit levels. So if you took this trade, you can just say, I want to target this high in the market and I will leave when price comes to this high. So you can literally just target that high as your take profit level. Good and fine. You've taken the first trade. After that, you can spot another entry. So we've already gotten the first entry from here. I want to mark out how many entries we've gotten. The one we got on the 4 hours time frame. Remember, directional bias we have already gotten directional bias. So now we are trading in line with that directional bias. So we got the first confirmation on the daily time on the 4 hours time frame. So that's the most important one, to get that direction on the 4 hours time frame. So that's the first trade we get. So whichever direction you want, you can still target the high here, good and fine. You've already gotten that first one. We got the second one. So if you missed this first one, you can still trade with the direction of the market and get the second analysis on the 1 hour time frame. Now, after this is the second trade. Good and fine. Let's say you missed this one, but you still have in mind that market is bullish. So you are still focused on looking for more buys. And remember, if we are looking for continuations, we focus on using double breakout structures. That was why I used the double breakout structure for the second entry and not the reversal concept. The reversal concept is for the first time confirmation of a new trend. Now, after that, you now start focusing more on double breakout structure. What I mean is by double breakout structure is that a market has been bearish. Before it will reverse up, it must give you a reversal concept. Now, after market already gave you that reversal concept, if you're now looking to trade more buys, now the market is buying, you use double breakout structure. You understand? You focus on double breakout structure until eventually, let's say market gives you a full retracement again. So before that full retracement to stop, if market wants to continue buying back up again, you will get another structure shift. But once it's bullish and there's not giving you a full retracement to the downside, if you're looking for more entries, you use double breakout structure for continuations. So that is it. So double breakout structure for continuations, market structure sheet for reversals. So now that we're still looking for continuations for buys, you can see another market do something like this. When this high was taken out, this high was also taken out. That's a double breakout structure. After that, this is an inducement. This can do weak pullback here, an inducement. Now, with the rules of picking a point of interest, the nearest POI to this inducement is this breaker block. So we're expecting price to come into this breaker block again for another continuation. And what the price do? Tap into that breaker block. So the first entry, second entry, we get another third entry. Now, with the third entry, if you want to take your profit, you can just implement what I taught you guys, take profit levels, trend line liquidity. If you guys are following me up, say power. Someone is asking why I don't use the first breaker. Why would I use the first breaker? This is the first double breaker structure here. Which first breaker? Which first breaker? This double breaker structure, inducement here. Is it this breaker you're talking about? This one. Even if I used it, my SL will still be here. So my SL will still be covered. It's still a valid trade. Does not matter. My SL will still be here. So that is hang on, guys. Please hang on. Give me a minute. Please give me a minute. I'm back. I'm back. Sorry. I'm back. I'm back. Are you guys following me up? Someone said I should display. So let me tell you guys what a valid inducement is. Now, let me tell you guys something. Let's assume this is a structure shift, and this is the candle that triggered the structure shift to happen. So this is the candle, and let's say like this is where it closed. This is the closure of the candle that triggered that structure shift to occur. Now, if there's the next candle that comes, if it makes even a slight pullback and then proceeds to take out the high of this zone that the candle that triggered that structure shift closed at, then this low is a valid inducement. And then if this pullback was not able to take out the, let's say it tried to, but it couldn't, and another pullback came out, and the pullback was able to still go and take out the high, then this will be the inducement. So if you check out this scenario here, this was the closure of the double break of structure candle. So this next candle that came out here that made a pullback was able to go out and take out the high. So that was why I marked it as a valid inducement. You guys understand what I was saying? Why is someone asking why I did not use the breaker close to inducement? I use the breaker now. I use this breaker block here. This is it. This is the breaker block. This is the inducement here. This is it. Now, this one's already been mitigated by the inducement. Price mitigated it already. When price came down here, it touched this breaker block. So the next one is here. So even if I pick this breaker block, this one, this is it. This is the entry now. What are you guys saying again? Abi, you don't understand the rules of picking a point of interest again. So let me continue what I was saying. So now you already know the direction that you're trading at. So the important thing is just to keep trading in that direction until price gets to the overall target, which is this high. So that is the next entry. So after that, let's assume you missed this one. Next thing again, look for what? Double break of structure, inducement, POI. So this is market being bullish. Now it took this high out. But at the same time, this high at the back also got taken out. So it's a double break of structure. After that, so this was the closure of the double break of structure candle. The market gave us a pullback. This pullback then proceeded to now take out the high of that closure of the double break of structure candle. So this is a valid inducement here. Now, with the rules of picking a point of interest, when market was giving us inducement, it mitigated this breaker block and then this breaker block here. So the only valid point of interest left here is the other block. So with the rules of picking a point of interest, is the one closest to inducement. So that's the next trade. So when market hit this TP here, another trade idea we got is this. Trendline liquidity for our take profit level. So you see how I'm confluencing everything I taught you guys. I use trendline liquidity for this take profit here. I also use it for this take profit here also. You see? Now, remember, so that is this next trade here. So that's basically what you're going to focus on, and then you keep trading like that until price successfully. You can even get another entry here, but it's not really that clear. But I can say this high, double break of structure. After that, this pullback, or I can even say this is the pullback here. Then the nearest POI, the breaker block. I can say this is the breaker block here also. So another trade again from here. Thing with this kind of breaker block is you have to cover the entire candles. If it's this, the breaker block is made up of 1, 2, and 3 candles. So here will be your SL just to avoid getting stopped out. But this is the other trade here again. Still targeting that trend line liquidity zone. So you already know you're bullish. So whenever market eventually see, let's say you took another entry here, you're not going to be perfect. Most likely, most of us will take buys from this breaker here. So even if you hit stop loss here, you can stay off the market and then wait for price to give you more entries for you to trade. So the moment you get that, can start looking for more buys again. So the thing is just to know that no matter what happens, you're not going to be perfect and hit overall TPs. But the moment market gives you some kind of confirmations or whatever, you already know the direction you are trading at. So you keep trading in that direction. So that is basically what you do. So you keep looking for buys till market successfully what takes out this high, and eventually price actually did. So if you have to look for more buys, there was a buy here from this breaker block. It's even the breaker block is better on the 30 minutes time frame, I think. But there's a buy here on this breaker. Um, there's a buy here on from this breaker. Understand? So the more you are trading in line with the direction of the market, the more you're getting more entries to keep looking for more trades. There's a buy here from this breaker also. So that was what market kept doing until eventually price took out this high. So when market takes out this high, then you can stop. But the thing with market, because this is an all-time high, so when market makes an all-time high, it tends to still trade in that direction for more period of time. But that one is you trade with experience now rather than like with technicals. Once you get the experience in trading all-time highs, very, very good and fine. But just know that whenever an all-time high has been made, market will still continue trading higher. And if an all-time low has been made, market will continue trading lower. But that's what your experience will teach you. But it's not every time that market is at an all-time high. This just happened to be when markets made an all-time high. But extensively, looking for trades would be to focus on to look for trades until price successfully makes a new high. So there are many places that we could have gotten more entries here. I even took this trade. This is a 4 hours, I mean 3 hours order block. This zone here, I took from the 3 hours order block. It was a buy there. I 4 hour, yeah, 3 hours order block here. It was a buy. So another buy, another buy. So you just keep analyzing, but now you know that you're trading in one particular direction. So you keep focusing on that direction until price gets to the overall target that you're expecting price to get to. But you already have a direction in mind that you're trading at. So that is the best thing about directional buyers. It makes it easier for you to look for trades. Now remember, the first time that price triggered our zone, we already got 1, 2, 3, 4, 5, 6, 6 entries. 7, 8, 9, 10. So, and this is just the 1 hour time frame. Remember, you get more trades depending on the time frame that you trade. There are always going to be opportunities presenting itself on different time frames, but I literally just had to use one time frame to get all these entries. So there are people that trade 15 minutes time frames. So because I'm trading 1 hour time frames, it would take longer for my setups to form. But people that trade 15 minutes time frames can literally trade 15 minutes time frame, 30 minutes time frame, depending on the time frames they are at, and they will see more setups every day, like per day, more than me trading the 1 hour time frame would see. But I'm just telling you guys, get the directional bias on the daily time frame, mark out the zones you're expecting the market to put before it reverses on the daily time frame. When price pulls to those zones on the daily time frame, go to the 4 hours time frame and look for confirmation. The reversal concept will be the confirmation. Once you've gotten that, then you can now go here. This is the trend line, and at the same time, it's a POI on the higher time frame also. That's this breaker block here. This is what I'm expecting the reversal to come into. Then when price taps this zone and at the trend line zone, what did they do? This same reversal concept did this and then came down to the other block here. This confirmed the reversals. So once this confirms the reversal, you can now start trading. But I remember this particular move that happened here. This was a news day. That was why markets actually hit that target very, very, very fast. It wasn't supposed to happen so fast, but markets hit this target very fast because it was a news day. I remember that particular day. In fact, the zone did not even trigger very well on Trading View. It triggered well on MT5, but on Trading View, it did not trigger at all. just came close to it, but the thing that saved us was that it connected at the trend line, but at the breaker block we're expecting the market to react from, it did not actually react well there. But on our brokers, like if you open MT5 and look at the broker side, it actually mitigated the zone, but it did not mitigate on trading view. So that is like market manipulation. It was a news day, but it's the same thing. Once market does that, it will give you the confirmation that you're looking for, and then you start trading in line with that direction and target the structural pattern of that particular trend that market is on. If it's an uptrend and it makes a higher low, then a higher high has to be made. And if it's a downtrend and it makes a lower high, then a lower low has to be made. That is how you trade directional buyers when it comes to trading trends. Are you guys following me up, please? So now, now the trend line way is not really the only way that we can also trade directional buyers. Do you understand? This is one of the ways that we trade directional buy. But like I said, whichever way the market presents itself to you is what you're going to do. You won't have a specific way you expect market to react from. That is why I said, aside from markets using the trend line method, there's also you trading the same setups you would normally trade on the lower time frames, on the higher time frames also. Do you understand? Now remember, the confirmation is just a one-time thing that you will get for the confirmation of your trend of your directional bias. And remember, if you miss that confirmation, even if you did not get the confirmation, provided that you have checked and market already gave you that confirmation, while at the level you are expecting that confirmation to come in from, then you can move on and start looking for trades in that new direction. So even if you are not active on the charts when the confirmation happened, as long as you check and you see that it actually happened, then you can move forward and start trading in line with that new direction that you got the confirmation in. So even if you didn't, were not active on the chart when it happened, you can now still move on knowing that it's already happened. So that is one way they can trade it by waiting for trends to connect. So majority of the time, trends connect. Understand? Trends connect majority of the times. So, but majority of the times it does not. So if it does not, you can now do the normal thing by applying the normal concept we trade. And this one you can use like 4 hours time frame. Sometimes you can also use daily time frame too. But if you want to use the normal way that we trade out the market to trade, you can apply that concept here. In fact, you can see many places that market did that. This is a structure shift. This is an inducement. Then the POI is this. Now, this is also a double breakout structure. This is an inducement. This is a breaker block. So the thing is, the same thing applies to the same concept. Once market gives you, comes to tap into those zones, based on the time frame you're on, if you're on the daily time frame and price taps into those zones, all you have to do is what? Go down to lower time frames and look for confirmations. So if it's a daily time frame, you can look at confirmations for the 4 hours time frame. So for example, this one that happened here, your market tapped at this zone on the daily time frame. If you say you want to look for the confirmations and you go down to like 4 hours time frame, this is, where is it? I think this was what I marked. Let me change the color. Yeah, this was what I marked out here. Yeah, this is what I marked out here. Yeah, this is what I marked out. This. So market tapped in here, just had to wait for that confirmation. So this happened. Price took out this high, then came down here again to this demand level. So I think it's clearer on the 3 hours time frame. That was what I used for this confirmation. It was not really clear on this time frame. 3 hours, right? Or 2 hours. Let me check. But the confirmation must always happen. Those are the confirmations are mostly not really that perfect. But should I go to 1 hour? But it's not actually a first time reversal, so I don't really blame it. But it's not a first time reversal. If it's a first time reversal, then it's going to be way clearer. But I think this was basically what market did. Just came to this OB here and then continue buying again. But the same analysis that you would apply on the lower time frames, like the 15 minutes time frame, you can also apply in the market on the daily time frame and still trade it comfortably. The only difference is that if you would take 1 hour for your POI to trigger on the 15 minutes time frame or on the 30 minutes time frame, then you can take days, months, weeks for your POI to trigger on the daily time frame. So if you have that same analysis, now let's say you have this, and let's say you have this on your 15 minutes time frame or 1 hour time frame. Now, with this structure, I'll mark out something and I'll give you guys something. This is POI1 and this is POI2. Which for this particular setup I have here, which zone are you going to pick for your entry? Is it POI1 or POI2? Someone say POI2. I beg, it's not POI1. No. It's not POI2. So it's POI1 because this is an inducement and the POI close to the inducement is what the breaker blocks or the POI1. So it's the same thing here. Even without drawing the trend line, it's the same thing here. It's the same thing that happened here that we're expecting price to tap into this breaker. It tapped into this breaker on the chart, but it not tap on MT5, but it not tap on the chart. But it's the same thing. Just like there was a manipulation here. So double break of structure, inducement, then the breaker block. But it just did not on the if someone goes to MT5, they will see that it tapped. It's just like it did not tap here. And that particular day, I remember this it was when I went to the chart that I discovered that there was manipulation in the chart. Same thing here. This is the other block, then this is the breaker. So after the inducement, nearest POI is this breaker block here. So market still tapped in here also. So the same analysis that you would have normally applied on the lower time frames, you can also apply on the higher time frame. The only difference is that it would take a longer period of time to trigger on the higher time frames, and it will also take a longer period of time for you to hit target on the higher time frames. That's why it's called a directional bias, because that amount of time it would take for price to hit that target on the higher time frame is basically all we need to be trading the lower time frames with. Because once market will take days or months to trade to hit final target, it means that for days or months, we have a direction in mind. We're basically going to be trading until price gets to that direction we're expecting it to get to. So the market is at that zone on the daily time frame. Then if it's a first time confirmation, like after a higher high, and if it's a first time confirmation for a higher low, you can now go to your 4 hours time frame, get your structure shifts, and get your reversal concept while market is at that same level. So once that happens, you can now trade the market like that and be going. So uh that's one way that we trade directional bias. Oh, sorry. And then yes, very, very good, very nice. Made a mistake. This is GBPJPY. I don't know who marked this one, but this is GBPJPY. Now, what do you guys see? Anyone that shrinks this chart and looks at it can see a clear uptrend. It's a clear uptrend. Now, if I did not want to apply the whole trend line concept, I can still apply this concept of markets giving me a double break of structure, inducement, then the nearest POI being the breaker block. Now, once market triggers that zone on the higher time frames, it pushed up. But this candle that came here still made a retracement to the downside. Now, so when it triggered, and then price took out this high, let's say, when I say this, I would only say this is the induced. It's not really clear, but when let me go to another lower time frame and see if it's going to be clearer. I want to say it has given me the confirmation I'm looking for. But okay. When price took this high out, would I say is this high that it took out, then this cost as inducement, and then price later came back here as the other block with this candle? It's not really that clear. I don't know if I'm going to go lower or the lower time frame to get this thing, but it's not really that clear here. That's the reversal concept is not really clear for GBP JPY. But all you need to know was that on the daily time frame, it triggered the zone we're expecting a reversal to come in, which is the daily time frame zone. So the last high in the market, if this was your lower time frame analysis, your take profit level for the market would be here. So because you're expecting the reversal to come here, so the reversal here, and you mark it out, your target to be here. It means that your market hits this target, your overall bias of the market is going to be bullish. Now, once this zone triggered, I'm trying to see if there was some kind of confirmation here, or if it was news that triggered. I don't know if some kind of manipulation or something, but I wouldn't really call it a manipulation. Maybe market will still give me a good confirmation. Maybe this zone will still end up getting tapped. That this other block level here. I will take this as a structure shift. I will take this as inducement. Then probably market will still come back and tap into this POI. But that is one thing that I want to tell you. So now, if the confirmation happens, I'm expecting market to buy until this high here gets taken out. So that is basically directional bias. Go to the daily time frame, spot zones you would expect reversals to come into the market from. So basically, either you apply the same analysis that you would normally do on the lower time frames on the higher time frames, or imagine here also we have this clear break of structure, market gave inducement and took out the high here, and then price eventually came out and then triggered our OB. So once this happens, take profit level will still be to take out the last high here. So what it means is that when market triggers this zone, you focus on looking for buys until market eventually gets the final target. So that is basically the same thing that you normally do on your lower time frames. You can also apply on the higher time frames. The thing is that on the higher time frames, it will take a longer period of time for the target to be hit than it would take for the market to hit on the lower time frame. So if you go to 1 hour time frame, would I say this was the this thing here. So I would say the confirmation is basically when price did this and then came back to this OB level here. That's the confirmation I needed in the market. After that, we now kept looking for more buys. So when this high gets taken out and this high gets taken out here, market gives us inducement. The nearest POI is this breaker block here. So that's the second entry. So you just keep looking for trades in that direction. Another this thing. This high gets taken out. This high gets taken out. Double break of structure, inducement, other block. So you just keep trading in line with general direction of the market till what price took out this high. That's when it stopped and price started making a declination. After that declination, you get more entries, and so that's basically so it's not hard. Trust me. All you have to do is what to go to. All you have to do is to what to go to higher time frames and then get what the market is seeing on the higher time frames. You can apply. Someone is telling me to do PIPS calculation and risk management. How? As how now? As how now? So all you have to do is just go to the higher time frames, get the same look for what market is doing. You can get the same analysis, the same structure, inducement POI analysis that you normally do on the lower time frames. You can apply it on the higher time frames. The thing is that on the higher time frames, you may not really see everything that clear because it's the higher time frame. But if you can just spot a POI that you can mark out on the higher time frames, once market comes there and gives you that concept of reversal while at that level, then you can expect that the market will hold that move. Then you now use your normal take profit level. If you can use the last take profit level, which is the last high or the last low in the market before your point of interest gets triggered, that's actually like the nearest draw on liquidity. So it will take a long period of time for that target to hit. And then once it will take a long period of time for that target to hit, all you have to do is now trade in line with the direction of the market until the final target hits. So you see, I should analyze for a downtrend. Not really had downtrends like that. Have I? Have I had downtrends? Because mostly not on a downtrend. Okay. For a downtrend, I can say this is a clear downtrend. This is a structure shift to the downside. So if this was the downtrend you're talking about, structure shift to the downside, the low of the structure shift ended here. So when price give us this pullback, this candle weak, and still proceeded to take out the low, we got our inducement. So with the rules of picking a point of interest, we would expect market to come and trigger this breaker block. So this is daily time frame. So the moment price does that and triggers this breaker block, we have already gotten the next move to the downside being what? Being bearish. So once we do that, you can now target that market is going to sell. So this is trend line liquidity here. So market will probably sell till this low gets taken out. So this is the same analysis I would normally apply on the lower time frames. I will also apply on the higher time frames. So what it means is that once this triggers, see, you can clearly see when market triggered this zone, it pushed down, but eventually pushed up again. That push up is that confirmation, that reversal concept. So once that happens, you now go to your lower time frames and you now start looking for trades to the downside until price eventually completes the cycle of the downtrend. The same thing you apply on your higher time frames, the same thing that you can also apply on your lower time frames. Same thing you can apply on your lower time frames, same thing you can also apply on your higher time frames. So it's not really difficult. Once you go to the daily time frame, you can apply the same analysis everywhere. This is let's say structure shifts. This how I was taking. This is an inducement. Price pushed up and eventually came to trigger this breaker block. Was the breaker block triggered? Price made this move and then pushed back down with this bearish move here. This is when market gave us that structure shift inducement and PRI on the lower time frames. So based on the rules of picking a point of interest and taking our profit in the market, if we check, you can clearly see trend line liquidity here for take profits. So we can apply this concept. So what it means is that market is bullish until this high gets taken out. Or if I keep going over and it's the same thing, daily time frame there are candlesticks too. The same analysis that you can apply on lower time frames, you can also apply on your higher time frames. The thing is that you just have to look, just shrink your chart and look. If you open up your chart, it's very clear. But what it means is that it will take a longer period of time for this target to hit. This is a daily candle. So it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It took 12 days 12 trading days, which will be 5 days, so that is 2 weeks plus for market to hit these targets, meaning that for 2 weeks, you are basically going to be trading just bullish moves. So that is it. So the same concept you will normally apply on your lower frames, you can also apply on the higher time frames too. Just that whenever you get that and you get the confirmation, when price triggers that daily time frame POIs, go to your lower time frame for confirmation, which is to get the same concept I taught you guys, reversal concept and the valid POI. Once you get that, you can now be trading any time frame you want, but you're trading that time frame in line with the current direction of the market on the higher time frames. You trade it until the final target that you already have on the higher time frame gets hit. That's why sometimes you guys will see me mark a horizontal line on the chart. It's not like it's anything special. It's just that that's the zone on the higher time frame that I've marked out for price to get to. So I'll keep looking for buys and buys or sells and sells until price successfully gets to that zone I'm expecting it to get to. Then I will stop. So directional bias is not really complex. It's basically just trading in line. Someone is the one asking me about Pips calculation. It's permanent in the comment section. I don't understand. Go to the YouTube and watch it now. Ah, God. So that is basically how I've been seeing for 1 hour, 30 something minutes. So that is basically it for directional bias. It's just that the same concepts that you apply on the lower time frames, you can also apply on higher time frames. And if it's basically like something that is trending, you can apply the concept of drawing out your trend line and then drawing out the zones that price can pull to, then getting confirmations and then trading it. So if you have any questions, please raise your hands with no, not in the comment section. There is a sticker for you to raise your hands and please ask meaningful questions, please. Please. Okay. Western West. Western West. Okay. You're not unmuting yourself. Ugochukwu gifts. You guys are not meeting yourselves. Kochuku gifts. Okay. Mwapong.
Okay, good evening, sir.
Yeah, good evening.
Please, I saw a situation on GBP JPY where on a daily time frame. Please, can you share your screen? Where you're having the buys, the first place you were showing on GBP JPY where you're having the buy. Okay, so my question is, for example, after price reacted to that first demand zone and broke structure, and now the next POI that you had was the second place where you had your POI on the demand zone. If price does not get to it, do you forget about it and concentrate on the new range that price has formed?
It's not likely that price will ignore it now. If price ignores it, then we move on. But you most likely just have to wait for it to trigger. You won't enter the market without your POI getting. That's why they have a POI for a reason. Your POI will trigger before you enter the market. If it does not, you move on to another pair.
Okay, sir. So if price does not trigger your POI and break structure, when you come back to analyze that pair, you focus on the new range.
That is if it completes like the cycle of the new trend, like the daily time frame, if it makes like a new higher high, then most likely you can forget the new distance.
Okay, thank you.
Yeah.
Hello. Good evening. Can you hear me?
Yeah, I can hear you.
Okay, so I have two questions. First of all, I would like to ask, when you're using inducement, it's it. Let's say you have your inducement and just a week takes it out, not the full body cover. Is that still a valid inducement?
Has to take out the MS. If it's an MSS or double break of structure and they can't do closes, the zone that they can't do closed, the inducement should be able to break that zone with a body candle and close above it with a body candle. That makes it a valid inducement.
So if it's just the week that takes out the eye, that's not valid.
That should be a body.
Okay, that's very valid. Okay, my second question is if you have an MSS marked out, and you have your inducement already, then you have your POI, let's say it's a breaker or an order block. And maybe price does not get there immediately. But then on the way up, like, 'cause let's say it's a bullish market, on the way up, price forms another DBOS on the way up. So do you still stick to your POI for that MSS, or you invalidate and look for entries with the trend?
First of all, MSS and DBOS are for two different things. Now, MSS is for reversals and DBOS is for continuations. Now, in a scenario where you're expecting a first-time reversal, there's no way you can start trading DBOS without an MSS, first of all, completing his work by confirming a reversal. So if you get an MSS and then a DBOS gets formed before the POI of the MSS gets triggered, but what you're looking for is reversal for the first time, you focus on that MSS POI first. But if market already gave you that reversal concept and then triggered the PR and is now moving up, then it gives you another MSS on the way, but continues to give you like more DBOS. You will focus on the DBOS because you're trading continuations and DBOS for continuations and MSS for reversals. So it depends on the particular thing that you're looking for. That or it now whatever you're looking for will tell you the concept you're going to use and trade it. If it's a first time reversal, market has been bearish. Before market will turn bullish, it must give you an MSS. And if it gives you an MSS, what confirms the MSS is the POI getting tapped. So if that POI does not get tapped, then any DBS that market formed without the POI getting tapped is not valid until market taps that POI. Except maybe on the time frame you marked it out, price did not tap it, but you go on the higher time frame, it turns out that market actually taps the zone, then that one is valid. But if market did not tap the POI at all for the MSS, wait for it to be tapped, even if more structures has been broken or market made more zones.
Okay, thank you. Sorry, one more question. Sorry. So let's say you have let's say you're trading continuation, DBOS, but then inside the continuation, you have your POI inside the liquidity. I know the last class you had the liquidity trend line. Let's say then your POI falls under the liquidity trend line. Do you still take the trade? How do you invalidate that liquidity trend line to be valid or to be one you can take a trade within?
Liquidity trend line is only is only used when you are looking for where to place your take profit levels. So if it's an uptrend and you have a POI inside there and market has not yet turned bearish, still continue using the POI. The only time you use it to oppose the market is when market's already turned like opposite of the current trend. So the market is bullish and it's giving you higher highs and higher lows. Obviously, the POIs will be inside the higher highs and higher lows now, will be inside the liquidity zone. But if market has not yet started opposing the direction, then there's no point trying to like use that as trend line liquidity. It's only when market's already reversing, maybe it is a POI to reverse or give you a structure shift inducement and POI showing that it's reversing. That's when you can now stop taking any POI inside of that liquidity zone to trade. So it all depends on when you see this. If it's just moving in your direction and it's forming higher highs and higher lows, you can use it. But if market is about to reverse, then that's when you now use that trend as liquidity.
All right, thank you.
Hello.
Hello?
Yeah, hello.
Yeah, good evening.
Yeah, good evening.
Okay, so my question is on that GBP JP1. Please, can you put your screen on the chat? Okay, so this the first trade you took, right? If you notice that price broke structure, then give us the first pullback, and the pullback took that high. Then why did you consider the other low as your POI instead of the breaker block?
Yeah, I'm coming. Now, this is a continuation trade. So the continuation trade is basically going to be double breakout structure. So when this high got taken out and this pullback happened, this other high here has not yet been taken out. So I considered when this high got taken out as a double breakout structure because the market is already bullish. So the market is bullish, you'd expect a double breakout structure. So when this high here got taken out and price closed above, that's when I considered a valid double breakout structure. So the pullback is this one that takes out the high again, and this is a valid
Oh,
OB.
okay. Okay.
Yeah,
Thank
and yeah. Please, you guys should focus your questions on general things and not telling me to go to my chat and go to my chat and go to my chat and go to my chat. I can't keep going between the chat and coming back and coming back. Anything you don't really understand, just open your chat. It's going to be there. You understand? Just ask general questions on what's confusing to you about the strategy itself, not a particular chart itself. The whole strategy, the whole concept. If I'm going to my chat and going to my chat and going to my, it's not going to fix up the general things you have. You understand? It's not really every trade I take. You understand? I have more experience. Do you understand? Just ask questions like based on the general stuff. So that other people can ask questions also. Because I've been teaching for close to 2 hours. So I can be able to get other people's questions. I can't be going to the chat and coming back, going to chat and coming back. Ask questions in line with the strategy.
Good evening.
Yeah, good evening.
So my question is, I have two questions. First is on the structure part. Now, for the structure, you said we should, we are trading a reversal, we should wait for the candle to close before we look for the inducement. So I've seen the scenario where the candle closed and another candle formed above it. It also closed, but the next candle that came went lower and maybe tapped another block around there. Then it now came back to react from the went lower and tapped the breaker block. Then now came back and tapped from the other block. Now, my question is because do you use premium and discount concept, or it is whenever we see that concept that you said, we can just directly go into, or we can actually also apply premium and discount strategy? That's number one.
I
Then
don't, I
number,
don't, okay.
okay,
No, continue.
okay. Then number two, if we get a break of structure and we are supposed to look for double break of structure, and let's say we got multiple break of structure and the candle closed above the recent high, or just a little difference. It didn't like close too much, just a little close. Then it created inducement around that zone. Should we consider that recent one as our, because you said we should look for the nearest POI. Now, in that scenario, we see that it still falls under the premium and discount. We see that it's very, very close. It has not mitigated any of those breaker block or whatever POI. Should we look at that point, or we should look at where double break of structure started instead of considering the multiple breaks with that small candle close?
Now, first of all, anything that I did not teach, I don't trade it. So as long as I did not mention premium and discount, I don't trade that. Secondly, whichever zone in the market gets taken out, it's not just a double break of structure. If it's multiple and price closes above any zone, whether slightly or hugely or whichever way it does, as long as it's valid and closes above that zone, gives an inducement, the nearest POI is what you're going to pick. Most of the time, the POIs actually stay on the same line. Like the one, the nearest POI, and they maybe like the other one below. Even if you draw it out, all of them will probably be on the same line. So price may touch the nearest one and still be able to go a bit inside to still touch the second one, but they'll all still be in the same line. So just apply the same concept I taught you there, and you'll be able to get this. Steven. Steven, please, if I'm asking you to unmute, just unmute because we have to hurry. It's going close to 2 hours and okay. If I skip you, I'm not going to come up again. I'm asking people to unmute, they're not unmuting. User, please, if I ask you to unmute yourself and ask the question now. User,
Evening, sir.
yeah, good evening.
Yeah, my question is based on your inducement. If you should mark your inducement like your inducement is somehow far from your entry, is it still valid? I don't know if you get the question.
Even if no matter how far it is, any POI closest to it is valid.
How about if your first and your
As long as
second
you're trading
POI
in the right
have been
direction.
mitigated? How about if your first and your second entry have
How?
been mitigated? So are you hearing me?
I can hear what you say.
What I mean is that if your inducement is far, let's say your valid entry is your order block, which is the first entry and the second entry have been mitigated, and your other block is your only valid entry. So
You pick the other block now.
okay, using the other block with the inducement, will it still be valid or not? That's what I mean.
Yes, now why will it not be valid? It's the closest POI to the.
Okay.
Oh, it will be. Why won't it be valid? It will be valid now as long as you're trading in the right direction. It does not see, guys. It does not matter the the behavior that market used when it was breaking your structure. It does not matter the behavior used in forming your inducement. It does not matter even if you did backflip to form your inducement and it did front flip to even if it's 100 kilometers, as long as you've analyzed your trade, because I don't really understand most of people's way. As long as you've analyzed your trade, you got your direction correct, you got your market structure shift correct, you marked out every possible point of interest, then there is an inducement. The inducement is the pullback that market will give you after the double break or structure candle closes, or after the MSS candle closes. That retracement into that direction it came from, that small retracement, or even if it's a huge retracement, before market will eventually go out and take out that candle that caused that MSS or double break or structure. That is your inducement. I don't really understand how I have to explain something again. If you're having difficulties with inducement, and someone asking the question, go and rewatch the videos, backtest the inducement. Like I can't, even if I stay explaining it from today to next year, if you don't go to the chat and forward test and get your own experience, you will never understand what I'm teaching. I don't understand how else to explain this. I've tried every possible way to, even today's class, I still drew it out and explained this. It does not matter what market did before any of these things happened. As long as it happens, and as long as it follows your concepts and your confluences that you need to take a trade, then take the trade. There's really nothing more. We're not complicating anything here. Uh, like we are not focusing on how far price it took to come to any POI, or how long it takes, or no, that's overcomplicating things. So please, if your question is based off of all these things, please remove your hand so I can answer the question of the people that actually have questions in regards to the strategy, because I don't really understand. Like, stop inventing things, stop inventing ways that market will react. Is You guys are complicating a lot of things, and I wanted to say something by the end of the class, like when people have finished their questions, but now I don't really the first question, second question, third questions, they are not really following up. Do you understand? So if your question is actually very serious about what I thought, but if you guys follow this in this 11, or it's even like 2 hours already, I will do this thing, and then we'll meet another person.
Right.
You guys you need your own personal experience with this to actually
Hello,
understand
sir.
very well. Yeah,
Hello, sir.
hello.
Good evening.
Yeah, hello. Good evening.
Okay.
Assuming that
Sir,
be a
I have
tactic, I'm meeting on the unexpected. Me is
Hello.
not welcome, me.
I have
Assuming
to
that
Please, if
be
you're,
who
hello,
they talk now.
who is
So
talking?
no.
Please.
what is for the equal highs and
Hello.
equal
Uh,
lows?
I
What is
don't
the
hello.
mark.
liquidity?
This is your first entry,
Hello.
Hello, sir.
second entry. For example, first entry no closer to your inducement.
Hello,
Yeah, who
sir.
is
Then an
talking?
price able mitigate first entry.
So who is talking?
I don't even know who they talk. Hello, sir. Please.
I'm
What
so
if for the equal
confused.
high and equal low, the liquidity is a bit like
Ah,
for the
I
equal
beg you.
high and
If
equal
you're
low, the liquidity one is a bit higher than the other. Should I still count it as an equal high?
how?
Like for the if I see two eyes on the like two eyes like the for the liquidity concept you taught us for the double top. I mean the you understand and the equal eyes liquidity you told us and equal load. If one is a bit smaller, like slightly smaller, should I still count
If
it as an equal eye?
It's asking if he sees two highs, and for liquidity concepts, and one is higher than the other, is it an equal high? When I was teaching, when I was teaching types of liquidity, when I was teaching types of liquidity, I remember. Now he was asking, he said, if market gives you an equal high and one is higher than the other, if it's a valid inducement. Now I remember specifically when I was teaching about different types of liquidity, I said an equal high is one that's on the same line as the other one. I said I haven't seen it on the chart in a while because it's been long I saw it on the chart. I know I specifically said on the same, like, please, guys, please. You guys should also help me out now. I'm trying to do this for people that have main questions to also ask their questions. The time is going and it's more than 2 hours already. There are things that if you calm down, you will actually understand without having to stress about it. I said on the same line on the video, I said it when I was teaching now. I said I haven't seen it on the charts in a while because it has to be on the same line. I even drew it with the line. So obviously, if market does not follow what I said, it's not a valid liquidity. I don't know. And I'm trying to take people's questions. So, like I said, I'll start doing after this now, not take questions, because now the questions are not even going with what I just did this thing. I was expecting people that were asked. There's one person that asked a question in the first class. I was like, guy, this is the kind of question I want. I've forgotten the first thing. I don't know if it's this class or something. But yeah, Moses Joseph, please. Hello.
Can you hear me, sir?
I can hear you.
Okay. I think I was left out. So I just have two questions. The first question is how the I saw you take some trade of gold, and the way you do calculate the nearest high before the reversal when it do make that higher high. That is the first question. And my second question is that I also do some like taking some trade on same but your market structure shift is not the same. I don't know the way you do people in your league. Because if you are using the swing, your inducement won't be in that place it is. I don't know if you understand me. I just notice don't pick swing in market structure most of the times.
I don't understand. What do you mean swing low in market structure shift?
Like you know the market moves in higher high and higher high, and the higher low is the swing low.
I don't understand.
Okay, let me put it this way. On maybe the process of markets creating the market structure shift, right? It's supposed to take out the last low. But there's a particular trade I saw. It did not take the last low. It did not take the last low before you mark the adjustment. Then it was about like 2 to 3 point of interest. Now pick the last point of interest. I just wish I could share my screenshots so you could see it.
Either the time frame I marked it from is not the time frame I got the entry from or the source sheet from, or you are just I don't understand. But see, I've never marked a source sheet is basically a deviation from the current pattern of the
This
or
particular question, I even sent it to your DM.
see it says it's my own chart typing. Screenshot the chart and send to me now. Let me see. My phone has died. Too.
Have you seen it?
Wait. So I don't understand. That thing you said code. Where exactly is the question from? I don't really understand.
You check it now. This is the last screenshot I sent.
Mm-hmm. You said it's my trade. Okay, wait, the last screenshot. Wait. Okay, talking. You see, yeah, that was the swing low, but does not mean that like it's the last low in the market. The last low obviously is uh, wait here. If it's the last low, a market is correct now. The analysis is correct. The low there was taken out. Market closed below there. The pullback is the inducement. The nearest PI is the other block I marked. The analysis is correct. What are you talking about? Like, guys, let me send this screenshot to you guys now. Yeah,
So you said the market structure is after the last low. If you break the last low and you not use the last low as the market structure shift, that's why I was
this last
asking.
low. I said when
Because the
market
inducement did not come after the last low.
I said an inducement is gotten after a market structure shift. I don't wait. I'm coming. I will show the distance to the people here. The reason and answer because I don't understand if it's the same class all of us. Wait, I'm coming. Guys, is this candle I marked here? That's the last low now. Price took it out. The next pullback is the week. The market took out the low again when it was creating the inducement. The nearest point of interest is the other block up there. And that was why I used to take the sell. What are you expecting again? Market took the low out there. And the low there is the last low before a new high pushed up. The low was taken out. Price gave an inducement by making a pullback. The nearest PI is the other block up there. Is this not you guys can see the chart, I mean? Is that not uh, is that not this thing? So what else are you saying?
How do you catch that your nearest high when the market is in uptrend?
Someone has asked me this question. There's an average move that gold does, depends on the pair. That's when you need experience in the market, or you can just Google some things, or just go to the charts of what you trade. Check daily candles, check how many pairs move on average. Then you can implement it on the next trades you take if it's at an all-time high.
You can just give us a clue. You
What?
can just give us a clue.
A what?
A clue, like just an idea on it.
I don't understand. Clue like what? I don't know the pairs you trade now. Go to the pairs you trade and check
You
how many
trade same
pips.
pairs as you.
Why would you be trading on the same pairs I trade? You go to the pairs you trade and then check the moves that market moves on a day. Check the daily time frames. Measure. There's a measurement tool on Trading View. Measure from the open of the day to the closure of the day, and you get the average move your pair makes uh, daily. So if a new day comes, you already know how many pips you're expecting the market to move. So if you get a POI, your pips movement will be at there, and it's only for all-time highs. And this is not a beginner class, self. No, I don't confuse those seriously. How which is not a clue like what? Market is not subjective to one this thing. The market is dynamic. So next month, market average movement can change to. There was a time gold was 100 pips. There was a time it's 200 pips, 300, 500. All you need to do is just go to the chart. It does not take time. Take your measurement tool on the chart, daily time frame movement for a day, it moves 200 pips. Okay, the next day it moved another 200 pips. The next day 200 pips on average. If you take a trade at an all-time high, you take it 200 pips. And why are you trading only the same pair as me? Trade other pairs too. No, I like to study you. Because if you study, this thing is not going to be hard. Plus, I have experience. I've seen the same thing since. Nah, guy, I don't. Hey, God. Yeah, I'm asking someone to meet themselves, please. Because it's 11 o'clock. I started teaching from 9, it's 10, 11, it's 2 hours something. person I asked to unmute is not unmuting himself. Prince,
Good evening, sir.
yeah, good evening.
Okay, so my first question is about when you've done your directional bias and you have a high that you're expecting price to take out as your final take profit. Before
Yeah.
price gets to that high, when you take out like some liquidity zones, price like makes like minor reversals. So when we get those reversals, if we want to when we want to continue trading back up, do we like still use double break of structure, or can we use market structure shifts when price like makes those reversals like at the end?
It depends on how long the reversal is. If the reversal goes on for like an extensive period of time,
Yeah.
like that, then before market will start pushing up, let's say the reversal happened for like hours and then it's like a long reversal, then you can use MSS to get market going back up again. But if the reversal was just for a, like, let's just say one or two pullback and the market continues making more structures, then double break of structure. But if
Okay,
you,
then when, because sometimes when you have your inducement and you have maybe your inducement, you have your inducement and you have your breaker block. Some of the times in the market just goes out, take the most recent high and come back to use your break the place you entered from as inducement and take a POI from below, even when there was an inducement before that one.
then you picked the wrong break now. You're not paying attention to the first double break of structure, the first MSS. Are picking from the recent one and not the one that actually like started the whole thing to the first structure.
Okay, sir.
Just
Thank
just,
you.
just pick your structure well.
Okay, thank you, sir.
Good evening, sir.
Yeah, good evening.
Um, I'm having some issues about that gold setup. I was one asking about the other block. Then, like you said, as you go to Google and search about the other block, I was very very confused by that because you told us that the other block must be engulfed by the by the new other block.
I know, but like I said, there's also different ways that other blocks present itself. That's an other block. I'm coming. Let me see if I open up and chat. Like I said, no, this is not. This is an other block. Yeah, there's a bearish candle, there's a bullish candle. The bullish candle did not engulf, but there was a third candle that came up that eventually engulfed the two of them. So that is still an order block. So your entry will just be picked at the demarcation of the three of them, 1, 2, and 3. I don't know if you've not seen this kind of order block before. It's called a demand zone, but it's an order block. It's a three candle order block. There's another
Okay,
block that also looks like a doji candle. That's
logical.
just another block. Yeah.
All right, sir. And again, on that gold, after you confirm your direction bias, you add your double break of structure and your inducement. But if you go back there, you see there is another breaker block, but it was not medicated. I don't know if you can go back. You see it there. It was not medicated.
I picked the right breaker block. The breaker block you're talking about, even if I mark it out from there, why I didn't mark it out is because it does not really have the shape of an other block. But even if I marked it out, the SL level will still be able to enter the other breaker block that I marked out. So they are all technically still on the same line. Is correct.
Okay.
Anything I analyze is correct there.
All right, sir. Thank you,
Yeah.
sir.
Mm,
Thank you.
mm. I'll be going off soon. I'm going to open up that group.
All
So
right.
if people type questions, I
Hello,
may just
Tony.
go and respond because I don't really. Yeah, yeah, hello.
I'm actually kind of confused on double break of structure. Now, in some charts, when you're about to mark out your double break of structure, you will see actually seen you use mark out one candle as like you will pick the first one, then on the body of on the wick of the candle, just one single candle, you mark it out as well. Now, most times you get to see like different, like more than one or two double breaks, like different ones. So at some point, if I mark those things out, if I mark one or two or three of them out, I actually do get confused on the actual one that the markets will definitely come and tap in. I don't know if you
That's
understand
why
what I'm saying.
that's why there are rules in picking a point of interest now. Even if you mark all of them out, you just have to look for where your inducement is. Then check the ones that are unmitigated. Then pick the unmitigated one that is closest to your inducement, and then that is the one you pick.
Okay, no problem. I'll make more. I'll practice more on that though.
Okay, guys, let me just summarize this and see. Someone is saying, can we have a compensation for our missed classes? The missed classes the classes that we missed was rescheduled. It's 4 classes total. I didn't do anything under 4 classes. We missed a class. We put another date for the class. Do we have classes on Thursdays? The classes we put on Thursdays was because we missed class on Sunday because of the burial things I did. So there's no compensation for this thing because the class that was missed. If I did those classes, I would not be hosting a class today. The class would have ended on Sunday. Do you understand? So that was why there's a class today. Because I missed the class on Sunday. The classes are complete. The amount of classes we need is also complete. Things that, in fact, we just got done with the classes. You guys have not even put it into practice. No one has even gotten their own experience trading the same thing. We've not even traded it for a full month. I feel like if you come down and trade this thing well for a long period of time, for at least a month, you'll be able to understand it. Most people are rushing. Calm down. Oh, I've been teaching for 2 hours plus. So, and then the questions that you guys are also asking me is not. So I'm just going to open up the group. Understand? So you guys can converse there, and the questions you have, you can drop your questions in the group also. If someone that knows it can also help you out, and me, I can occasionally check the group sometimes and then see if I resolve the questions they have if you tag me. But for now, I think that is it this for this class. So the Zoom recording is going to be available once it's done processing. Just imagine if all these things did not record. Just imagine if all these things did not record. But overall, what you guys should focus on is not to try and complicate trading. Trading should not be complicated. If you trade just one thing 2 times in a week, trust me, you have a higher chance of being profitable than someone that looks for 100 trades in a week, trading different things. Focus on risk management, number one. Focus on having a plan to trade with. If you trade less, me, I trade just 3 times in a week, or else I try to. Simply because I already have some kind of knowledge on technicals does not mean I'm above mistakes. I'm just 2 years into this trading industry. I've only been trading forex for 2 years, so I still make my own mistakes. But I try to trade only 3 times in a week. That way, even if I hit just one TP, with the kind of RR I have, even if I have 1:5 RR on the first trade, there's no way I'll lose the next 2 trades and I will be in loss. Even if I take the next 2 trades as losses, I will still end the week in profit. But the thing is that I can if you take much more amount of trades in a week, that's when your percentage risk will be lower. But me, I trade 3 times in a week. Sometimes I can do my percent 20% or 10%, knowing that even if I'm risking 10% per trade and I trade only 3 times in a week, at the end of the week I'll be down 30% if I lose all 3 trades. But if I hit just one TP and win and lose the remaining two, I will still be in good profit. So one thing is planning, and another thing is limiting the amounts of trades you take to just trading what whenever the market presents as a setup to you. So that way your mind will be calm, so you can actually trade well. And at the same time, you've already planned everything. I have a plan for when the market, for when I hit 2 losses. I have the plan for when I hit 1 loss. And I have the plan for when I hit 3 TPs. I have a plan. That's why I'm able to scale up. I plan everything I do. If I open up my notes, I have a plan for trading $100 account, 1K, 2K, 5K for me. So at the end of the day, I have a target that I'm meant to hit. I have a plan of what happens when I hit 2 TPs and 1 SL. I have a plan on how many withdrawals I'm making. Those things will help you go fund. At the end of the day, you need capital as a trader. Forget all these things that we do. One of the reasons why you see me stacking positions sometimes is just because I'm trying to scale up to a level where I can comfortably have a percentage risk and stick to it. If that was the trade I took, I turned $300 to 17K. Eventually, that 17K became my capital. So I can now risk like 10% per trade. If I risk 10% of 17K, that's 1,007. If I do 1 is to 10 risk to reward ratios, that's 17K profit again. We're risking just 170 in one trade. I don't have to overdo it. But once I do that, my account is already going to be at 40K. You understand? If I take another trade and I lose 10% at 40K, 10% of 40K is 4K. If I lose it, I will still have 36K. If I risk another 10% of 36K, that's 36. If I lose it, my account will still be at around 32K, 33K. So can you see how I'm able to still close the week at more than 20K in profit just by sticking to 10% risk per trade? So that's just it. So plan your trades, plan yourself, and then what trade only the concept that you are taught. Do you understand? There's no need adding other things to it. Don't complicate your trading. Make sure you have the market will, like, there's no particular way that market does something. You can watch market give you a break of structure, and before it happens, it will just go straight and break the structure once without any other candle coming out. And on the next time the market breaks structure, it can use two candles. It will try to break the first time and they will not break. Then another candle will come up, will break it. That is still a break of structure. No matter how it happens, as long as it happens, then it's a valid break. So don't complicate things. Just focus on making sure that you've seen what you're looking for. If you actually focus on that, you're not going to complicate yourself. Also, the questions that people are asking me here, they are complicating themselves because they are way focused on me that have been trading the same thing since 2023, the same concept since 2023 till now, trying to get the same amount of experience that I have just in a month of me teaching them one thing. So build your own experience also, but you can use the blueprint that I've already laid out for you guys to now do that. So that is it for this class. I hope you guys enjoyed the class and I hope you guys understood what I taught. Trust me, if you stick to what I taught you guys, it's a proven strategy with a proven track record and it works. It works. So majority of the times that would take losses, even me, I take losses. My losses, if I ashamed to post my loss, if I'm ashamed to post a loss that I take in the market, just one I did not follow my plan. I can wake up in a day and not analyze anything and just feel like markets will go in my direction and I would just fund and I would trade it. If I take that loss, that is not a proper loss because it was not planned. It does not follow how I trade. It's just basically me buying and selling at any place. So avoid trading like that because trading can be addicting. And then if you don't control it, it will control you and it will ruin you if you don't know what you're doing. Plan yourself and stick to the plan. Hope you guys enjoyed the class. And I'm going to open up the group for you guys. And also, once the recording is done processing, I'm going to send it to the group chat also. But for now, till we meet again.